Target maturity funds are passively managed open-ended index funds which endeavor to replicate an underlying index. The index for these funds is provided by index providers like NSE or CRISIL, and these funds tend to invest in highly rated securities like government securities, AAA rated corporate bonds, or AAA rated PSU bonds, and state development loans, which are also called as SDLs. And if an investor invests till the maturity of these funds, which is the target maturity, then the investor also enjoys a very high predictability of returns that he will be able to get from this fund. Index maturity funds have a lot of benefits if one were to enlist them. First is that they are open-ended in nature and there is no entry or exit load. Over here, you don't have any exit load. You get money on T+1 basis. Second biggest benefit is that there is tax efficiency over here. Debt mutual funds, where the investment is more than 3 years, attract long-term indexation benefits as per the extent income tax rules, and from that perspective, investment in these products till maturity become tax efficient in nature. Third is that there is greater transparency in these funds because a fund manager has to try and replicate the underlying index as per the SEBI regulations, and there will be not too much deviation from the index, and so that provides transparency as to what papers will go in the fund. And from a maturity perspective also, the maturity is fixed in this. So in all, if you were to summarize and look at it from a different perspective, fixed income investors have 3 risks when they invest in any fund, which is interest rate risk, credit risk, and liquidity risk. And now, since this is a target maturity fund, and if you are investing till the maturity of the fund, there is no interest rate risk because you are going through the entire journey of the fund. From a credit and liquidity risk perspective, these funds invest in high quality papers like GSEC, AAA papers, and SDLs as we discussed. And if you are investing in these papers, there is the mitigation of credit risk as well as liquidity risk in these funds. Right now, yields have risen substantially from where we saw them in the COVID period. So from the COVID period to now, yields have risen by almost 150 basis points, which provides a good entry point for investors looking at investing in fixed income. If we were to look at the explanation as to why these yields have went up, these yields have went up because of elevated inflation that we saw because of the Russia-Ukraine war, and a large part of this increase is explained by the higher fiscal borrowing, means the government has borrowed more, especially during the COVID period and thereafter, because of the spending that they had to do to boost our growth. So because of that, there is a higher amount of fiscal borrowing, whereas corporates have borrowed lower. So your yield curve has, especially for the sovereign and the AAA space, is elevated right now. So which provides an opportunity for people to invest now, because as we go ahead in time, these higher fiscal numbers will come down, and the current window provides an opportunity for fixed income investors to take benefit out of the same. So now the question is for investors as to where should they invest now. So from an investment perspective, if someone is looking at a short-term investment nature, then we have our ABSL CRISIL IBX AAA June 2023 fund, which matures in June 23 as the name suggests, and invest in AAA rated corporate bond securities. So for short-term placement, investors can look at investing over there. But for investors who want to invest more than 3 years horizon, and more than 3 years you get tax benefit because of the long-term indexation that you get, we are recommending 2 funds that we have, which is ABSL SDL PSU 6040 index fund and our ABSL Nifty SDL April 2027 index fund. Each of these funds invest in predominantly sovereign or AAA PSU securities, and these funds look good right now from an investor's perspective.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.